Hi, my name is Dan Page, and I'm the president of Boulder Equity Partners. We are commercial real estate lenders funding nationwide for all types of asset classes, all types of loans. Today, I'm here to talk to you specifically about construction loans and understanding what we call the 4 E's of construction loans. So construction loans are really challenging right now. Post-pandemic, there are fewer lenders that will actually fund construction. Banks are, for the most part, backed out of construction lending, and when they are lending, they're lending far less than they used to. So it's hard to get any loans adequately funded through banks right now. Construction loans are a very complex transaction, a lot of tough qualifications and variables that you need to understand. And there's a lot of competition for these loans right now. So um, we're here to try to explain what you need to be able to do to get adequately funded. So to be competitive, you'll need to have, again, what we have coined as the 4 E's of construction loans. The first E is experience. So to be competitive, the borrower or sponsor, terms that we use interchangeably, and so does the industry, needs to have a proven track record with similar projects. And let me give you an example of that. If your experience has been in building or renovating single-family homes, and now you want to build out a 100-unit complex, that's fantastic, but you don't have that experience. So you're going to need to partner with someone who does. That can be another builder or another equity partner or your general contractor. But you'll definitely want to have adequate experience on the table that's similar to the type of project that you're endeavoring to take on. The next E is equity. So we're not going to fund 100% of your project typically. No lender is going to. You need to have your own skin in the game, as the saying goes. So I fund up to 85% loan to cost. You can expect somewhere between a 75 to 85% loan to cost. That means you as a sponsor need to come to the table with the difference. So if you lack the added liquidity, you'll need to bring in equity partners, personal investors, limited partners, um, family members. You need to have the appropriate equity there to show that you have cash in the deal. So that sponsor equity can include not only cash, but any amount of money that you have spent on that property. That can include the amount of cash you would spend on the land, any engineering, any permits you've worked through, architectural drawing, any development you've done on the land. All those things that you can track back to show your what's called your borrower basis, how much you have spent on the land, is all considered equity. However, what won't work is what's called imputed equity or inflated land valuation. Great example. I've heard many times where somebody says they bought the land 6 months or a year ago for $1 million and got a great deal on it, and it's actually worth $3 million. So they have $2 more million in appreciation despite no additional money put into the project. And I'm telling you right now, that's not going to fly. In fact, it jeopardizes your credibility to even make such a claim. So please don't do it. Next is an interest reserve. So in order to be able to fund the loan, every time you make a draw, you'll have to start paying interest on that amount of money that you borrowed that month or that quarter, and that can get expensive. So we will set up what's called an interest reserve. So built into your loan is an interest reserve, so you are sure and we are sure that you're always going to have adequate cash to make your monthly payments. Now, if you and your investors have adequate cash coming out of the gate, that can save you a lot of money because you don't necessarily need to have an interest reserve. And it makes your cost of financing less because you're not paying interest on that amount of money, allowing more money available for actual construction cost. The next E is entitlements. Entitlements can be things like zoning variances, building permits, anything that has to do with getting that property ready so that it's ready to build right now. Now, keep in mind that zoning issues can take sometimes months and many meetings with your local municipality in order to get zoning approved for a particular property. A great example can be someone who has purchased a vacant hotel and it was zoned for hospitality, and now they're converting it to multifamily, which is a very typical scenario in today's marketplace. That's great. But if it's zoned as hospitality, you need to get it rezoned for multifamily and residential before you can actually get in and get a loan approved. So get all that buttoned up ahead of time. The last and very important E here in my realm is exit. So what is your exit strategy? A construction loan is always going to be temporary financing. 12 to 24 months is the typical. Can it go longer? Yes. It can be extensions or it can be a longer path because sometimes the very larger developments will take longer to get built out in phases. But at the end of the day, it's a temporary loan. So you need to have a clear path to pay off that loan at end of term. So that's something that I look at right up front. What is the exit going to be on the loan? How are we going to refinance that loan, which may be into a bridge loan while you're leasing that property up, or sometimes it can refinance directly into a long-term loan if you've worked with pre-sales or pre-leasing, which we'll talk about in a moment. But bottom line is you need to have a very clear exit so you're convinced and we're convinced that we'll be able to get you out of this loan and into long-term financing or those units sold prior to your construction loan terming out. So there's going to be different metrics to apply for different types of financing. And that financing is going to be based on the stabilized value. If it's refinancing into a long-term, what's called an agency loan or a bank loan or a life insurance company loan, typically that loan's not going to be more than 65% of the stabilized value of that property. And we're going to use very specific metrics on that, running it as if that loan were refinancing into a long-term loan. We're going to do that ahead of time to make sure for your protection and for ours that would be able to get you out of that loan at the end. So that loan is going to be based on market comps and market rents. So we're going to be looking at very detailed metrics comparing the size of the loan, the type of the loan, the location, and the likelihood of being able to refinance that loan at completion of the property construction. We'll also be looking at the local area, the crime stats, the occupancy rates, what's called the absorption rates, which is how long units tend to lease up in your area. By far, the best way is to be able to prove market interest for you is through pre-sales or pre-leasing. So if you're selling these units, it'd be great if you have pre-sales. Some units are already pre-sold before you even start construction, or pre-leasing before you even start construction with signed contracts and leases or deposits. That's by far is going to bubble your loan to the top of the stack when you're applying for financing. So I hope this has been helpful for you. Boulder Equity Partners, again, we're a commercial real estate lender. We do long-term, low-interest loans, bridge loans, and of course, construction loans. Especially folks that are working on a tight deadline. Personally, I've been in this industry well over 30 years. I funded well over $1 billion in loan transactions. I'd love to be able to help you. My direct line is 303-938-8280, or you can reach me at Dan, my first name, at boulderequitypartners.com.